Welcome to day 7, Powerful Trading Strategies to Master. This is the final day of your trading education journey. Today, we'll dive deep into 5 practical strategies used by traders around the world. These could be your magic formulas. They offer frameworks that can help you improve your odds when used with discipline and proper risk management. We'll cover the 1-to-3 risk-reward rule, the Martingale Strategy, the bouncing ball, the Triple Hedge, the cover the red strategy. Let's begin. The 1-to-3 risk-to-reward ratio, a smart way to stay profitable even when most trades lose. The 1-to-3 risk-to-reward strategy is simple but powerful. For example, you risk $100 on each trade. This is your stop loss. You aim to make $300. This is your take profit. That means you only need to be right a few times to come out ahead because your wins are much bigger than your losses. Why it works. Let's say you take 10 trades with this structure. You win 3 trades, earning $300 each time, total of $900 profit. 7 losing trades by $100 loss would mean $700 total loss. So $900 profit and $700 loss, meaning total profit of $200 only by succeeding in 30% of the cases. Even though you lost 70% of the time, you still made a profit. That's the magic of risk-to-reward trading. How to execute this strategy? Open 10 trades in the morning, all of them with the same stop loss and take profit. Make sure the take profit is 3 times bigger than the stop loss, $10 to $30, or $100 to $300, or $1,000 to $3,000, etc. You need to be right in only 30% of the cases so you would be profiting. Can you make 30% successful predictions? Any successful trade over those 3 is bringing even bigger profits. Repeat this process with proper analysis and discipline, and you can remain profitable over time. What are the pros of this strategy? Low win rate, still profitable. Even 3 out of 10 wins can lead to profit. Encourages discipline and proper planning. You don't need to be online long time. Avoids chasing big risks for small rewards. What is the downside? If your take profit is too far, price might reverse before hitting it. Here are some tips when you use the strategy. You can combine this strategy with technical analysis, support, resistance, patterns. Use consistent position sizing to manage your risk. This is very good risk management strategy which any trader may use. Let's move to the next strategy, the Martingale method, doubling down on losses. The term Martingale comes from 18th century France. It was originally a betting strategy in gambling. Double your bet after every loss to recover everything with 1 win. It was later adapted to trading. Let's imagine this. You're trading gold, currently priced at $3,700 per unit. You expect to go up, so you buy 10 units at $3,700. But gold dips to $3,680. That's a $20 drop. You're in loss, but you're confident a reversal is near, so you double your position. You now buy 20 units at $3,680. Gold dips again to $3,660. You double again, 40 units. And one last time, at $3,640, you buy 80 units. Then, finally, gold bounces up to $3,660. That's just a $20 move up. But that tiny move is enough to cover all the losses and still leave you with a nice profit. Total drop before bounce, $60. Total bounce back, only $20. Profit, $800 thanks to last large position. Why it can work. Each time gold drops, you buy more, at a better price. Your last and largest trade is the most profitable when gold reverses. Even a small recovery, just $20 in this case, covers all your losses and you make profit. The risk, you needed to go from 10, 20, 40, 80 units. That's 150 units total, and 8 times more exposure on the last trade. If gold had dropped another $20 or more, your losses could snowball. In a strong downtrend, this can wipe out your entire account. This is not a beginner strategy, and not for trending markets. Risk management tip. Only use Martingale in ranging or bouncing markets. Avoid more than 3 to 4 levels of doubling. Start with very small trades. Always watch your margin level and account balance. Set a maximum loss point. Don't go all in forever hoping for a bounce. Final thought. Martingale gives you many chances to recover, but only if the market plays along. In our case, a simple $20 bounce after a $60 drop saved the day. But if the bounce came later, or never came, you'd be over-leveraged and trapped. Know your limits. Use logic, not just hope. The bouncing ball. Imagine a ball hitting the floor. It bounces up. In trading, prices often behave the same way when they hit a support level, a price point where demand is strong enough to prevent the price from falling further. This strategy is about buying at that level, expecting a bounce. We're not guessing the top or bottom. We're using clear visual signals and predefined support areas to catch short, high probability upward moves. How it works: identify a strong support level. This is usually a price where the market has bounced before. You can spot it by looking at horizontal lines where the price reversed multiple times in the past. Wait for price to approach that support level again. Be patient. No trade is taken until the price touches or gets close to the support. Look for confirmation. This could be a long wick on a candlestick showing rejection of lower prices, a bullish engulfing candle, positive RSI divergence, or even a sudden increase in volume. Enter a buy position. As soon as confirmation appears, you place a buy order. Set stop loss a bit below the support level, $30 or $50 depending on volatility. Set take profit. Based on previous highs, a 2-to-1 or 3-to-1 reward to risk ratio is ideal. What are the pros of this strategy? High probability setup when used with confirmation. Limited downside, tight stop losses. Can be used on any time frame, scalping or swing. Where are the risks? Support may break instead of holding. False confirmations can lead to losses. News events can push the price through support unexpectedly. This strategy is ideal for traders who prefer precision entries, those who want clear rules and tight risk control. Works well with technical indicators like RSI, MACD, and volume spikes. Triple Hedge, smart currency shielding. The Triple Hedge strategy is a smart, low-risk method used by traders to hedge three major currencies across three correlated forex pairs. This strategy is built for currency pairs only, and it helps you stay protected from sudden moves while still having a chance to profit. Imagine you're working with three powerful currencies: Euro, US dollar, and British pound, GBP. The goal is to open three trades that balance each other, so no matter which currency moves, you're covered from all angles. Here's how it works. You believe Euro will go up versus USD, so you open buy Euro USD. But if Euro drops, you'll lose. So you hedge that risk by betting against Euro in another pair. Sell Euro GBP. Now you're exposed to GBP, so you finish the triangle. Sell GBP USD. Result: you hedged Euro, you hedged USD, you hedged GBP. So you are hedged in all directions, and as the market starts moving, you wait for 2 out of 3 trades to go into profit, and you can close all of them once the total result satisfies you. Or you can close the profiting ones and wait for the others to turn into your favor. Why is this smart? You're not relying on just one move to profit. If you are a beginner trader, it gives you more time to get used to the market and still open many trades. If 2 trades go in your favor, you can close them with profit, then wait for the third one to reverse, or close it near break even. You're not panicking if one currency acts weird. You're strategically spread out. Easy way to remember. Trade 1. Pick a direction. Example, buy Euro USD. Trade 2. Hedge the first currency. Sell Euro GBP. Trade 3. Hedge the last one. Sell GBP USD. It's like a triangle of protection, where your risk is distributed across 3 pairs. Here are some tips. Use this only on strong major currencies like USD, Euro, GBP, JPY, AUD, or CAD. You can use any 3 currencies to correlate them to each other. Once you become good at this, you can extend to 6 currencies, 9 currencies, etc. Cover the red, the strategic reversal. Sometimes you enter a trade with confidence, but the market proves you wrong. This is not random doubling down. You only use it when support resistance level breaks. A news event shifts sentiment. An indicator confirms a new trend. Let's see an example. Let's say you're trading gold, currently priced at $3,700. Step 1. The initial trade. You buy 10 units at $3,700, but the market falls to $3,650. That would mean your position would be on $500 loss. At this point, you reassess the market. Maybe a support level is broken, or a bearish candle confirms a downtrend. You decide. Gold is heading further down. Step 2. Strategic reversal trade. You now sell 30 units at $3,650, 3 times bigger trade. Price drops to $3,600. Profit from the sell is 50 by 30 equals $1,500. At this point, your original buy is still down $1,000, from $3,700 to $3,600, but your sell has gained $1,500. Net result equals plus $500. You used a high-confidence move to reverse the loss and covered the red. Here are the most important principles. Change of bias. Only reverse when you have clear technical or fundamental signals. Larger size on the new trade. The new position should be large enough to cover the previous loss within a reasonable move. 3 times bigger or 4 times bigger. The bigger it is, the faster the cover. When the loss is covered, you can close both positions together. Or if you see that the first one is about to recover, you can keep it. Final words, wrapping up the Trading Strategies series. Congratulations, trader. You've just completed day 7 of our trading education journey, where we dive deep into real-world, battle-tested strategies like Martingale, doubling down to recover smartly; Triple Hedge, protecting your currency trades from volatility; 1 to 3, Risk-Reward, planning your trades with math, not emotion; Cover the Red, when to strike back with a powerful reverse position; Bouncing Ball, trusting support zones like a pro. Each of these strategies comes with real examples, calculated risks, and visuals to help you understand not just the what, but the why and the how. But this is just the beginning. If you haven't watched the previous days, go back and watch them. Each lesson builds a foundation that makes the next one even stronger. So, what's next? Knowledge is your weapon, but to truly grow as a trader, you need a real trading platform, real-time market data, real execution of the strategies you've learned. Need a broker? We've got you covered. If you're looking for a regulated, reliable broker to put this knowledge to use, check out our top recommended brokers. These brokers are licensed, secure, and perfect for beginners. You can start small and practice what you've learned today. Some even watch protected trades, so you can explore with confidence. Final reminder, trading can be rewarding, but it comes with risks. Only invest what you can afford to lose, and always apply money management strategies. Thank you for joining us. We created this series to give you a head start, a plan, and the confidence to enter the world of trading, without the fluff, without the scams, and with your eyes wide open. Subscribe to our channel for more advanced lessons, live trade breakdowns, and strategy updates. Got questions or want coaching? Drop a comment or visit our site for one-on-one help. And if you haven't already, get access to your free trading resources at traderslessons.com. See you in the markets, your Traders Lessons team.